We are back. MSTR True North, I guess. So sometimes I have these moments where, something is incredibly interesting and or bothering me, and I need to get to the bottom of it and figure out exactly how it works, why it works, who's doing it, what's going on, etc. So the time has come for Strike, uh, for me to learn a little bit more about Strike because it's really been bugging me and I've been trying to figure it out. And I wanted to walk through some of the things I found, some of the things that I'm thinking about, why I think somebody would buy this. So I'm going to go over a few things. I'm going to go over why somebody would issue preferred stock, who issues preferred stock, why do they issue preferred stock, how do they do it, what are they thinking about, what does the scale look like, who cares, uh, and then talk about incentives and how this applies to MSTR. So, I mean, this is a totally fascinating product. It has been the top of my mind for the last week now, and I think it's incredibly accretive to MSTR shareholders, and incredibly accretive from a Bitcoin yield perspective. So, totally fascinating product. Let's get into it. And it looks like we got some people in the chat. Hell yeah, let's do it. So I'm going to get these thoughts out, and then I'm going to run to a Bitcoin meetup. So hopefully I can do this in 20 minutes, maybe 30 minutes. We'll give it a run. Okay. So we're going to start on the screen. Whoop. Here we go. Let's zoom in a little bit. All right. So I employed the help of Grok a little bit to give me some perspective here, right? Why do companies issue preferred stock? And prior to MSTR coming out and issuing preferred stock, I thought most companies that issue preferred stock, they're either like young tech companies issuing preferred stock to like early investors that want to make sure they protect their downside, or it's companies that are generally in trouble. So when I ask Grok, why do companies issue preferred stock? Grok comes back with, you can raise capital without diluting voting control. You have flexible financing options. You can attract specific investors, right? So specific pools of capital like preferred stock ETF, et cetera. You can improve the balance sheet perception because preferred stock itself isn't debt. It's just additional equity, especially if it's convertible at a future point in time that could remove the dividend burden. Sometimes there's some tax advantages, and you have some general strategic flexibility. Now, the one thing that Grok is missing here is it doesn't say that some Bitcoin treasury companies issue preferred stock because it is the most accretive way to add Bitcoin per share to your underlying equity. And so MicroStrategy has figured out this cheat code effectively with the preferred stock, because it's they can issue the stock with a conversion price significantly out of the money. And I think the architecture and mechanics of what's going on in the market are particularly interesting, and we'll get into that at the very end. So in this circumstance, MSTR is incredibly unique. Strike is incredibly unique because this preferred equity itself has this, nuclear core of Bitcoin that sits beneath it. So it's very similar to, how Saylor's attracting capital in this convertible bond market, because there's, multiple reasons for holding it. And that volatility is really what gives it a lot of juice. Now, I wanted to, start here. Why do companies issue preferred stock? And then think about who is issuing preferred stock. So I look at the iShares. So this is the BlackRock preferred stock ETF. So I wanted to get a sense of scale, right? Like how much preferred stock is out there in the market? Who's issuing it? Why are they issuing it? Yada, yada, whatever. So the largest company in this preferred stock ETF is Boeing, which I found pretty interesting. And, within this BlackRock preferred stock ETF, there's 557 million of Boeing preferred stock in this single preferred stock ETF. which I find pretty fascinating. It makes up a pretty large percentage of this preferred stock ETF. So now I take a step back and think about Boeing, right? Why Boeing? Why is Boeing issuing preferred stock? And I recall that Boeing issued in October of 2024, Boeing issued a $24.25 billion preferred equity offering, including a $5.7 billion issuance of depository shares. So, maybe it's 5.7 billion of preferred stock. Anyway, regardless, it's a ton of preferred stock, right? Boeing's issued a ton of preferred stock. Now, let's think about like what's the landscape with Boeing, right? Um, you've got planes landing upside down on runways. You've got alleged hitmen, knocking out witnesses before they're about to testify about why their planes are exploding, right? Like the sentiment around Boeing right now is not very good. And what I think is happening is there's a lot of capital that may be interested in Boeing, but there's no way in hell they want to take equity with the full downside. So they'd prefer to have this preferred share, which sits higher in the capital stack and protects the downside for the investor. Basically, if Boeing goes bankrupt, preferred stock is going to be getting money before common stock shareholders get any money. Now, you think of Boeing, right? Boeing's probably too big to fail. But what if they're not, right? What if they're not too big to fail? And if they're not too big to fail, you definitely want preferred stock over common stock. So there's a different buyer that's interested in buying Boeing stock or Boeing preferred stock. Now you have this new buyer coming to the market. Oh, also when you think about the upside for Boeing, right? Let's look at the scale. So Boeing issued a $24 billion equity offering in October. Boeing's a $120 billion market cap company, right? So it's about 20% of the size of the company, of the market cap of the company, which is just massive, right? Like that's just huge in comparison to the size of the company. And I also did just a quick and dirty here on Boeing, just to give some perspective. Boeing has $119 billion market cap, $156 billion of assets, $160 billion of liabilities. So their net asset value is technically negative $4 billion. Yeah, that's an interesting statistic. They have $52 billion of long-term debt. So I think this liability is a function of the preferred stock dividend or, some combination of outstanding debt, et cetera, et cetera. So just interesting to be aware of. Now, I wanted to shift gears into, strategy, right? So strategy is issuing preferred stock. Who's buying the preferred stock? Why would you buy the preferred stock? And what's the benefit of holding the preferred stock? Well, the Fed funds rate is 4.33%. So you need a dividend payable that's higher than the Fed funds rate. But you also have this component of a perpetual call option attached to the preferred stock. And if you are long strategy, let's just say you've got a portfolio of Bitcoin equities and MSTR and all this other stuff. Let's say you had a side bit of cash, or you wanted something that's going to generate some income in your portfolio, but if your thesis is Bitcoin's not going to break, and strategy is in such a strong financial position that I think the downside is limited, this could be a decent location to have a protected downside asset in your portfolio, generate 8% dividend yield, or maybe 9% dividend yield with the price of the stock as of today. And then you still have that perpetual call option. So you can be long strategy shares at the same time, which, I mean, this is it's just it's a hybrid instrument, right? Like the preferred stock itself is a hybrid instrument. It's got this dividend component and protected downside because it sits higher in the capital stack, right? It's got liquidation rights before the common stock shareholders do. But then you also have this upside, which I think is demonstrated pretty well in this chart here, this model. This is a 3D representation of the potential value, or I think it's trying to identify the price of strike given the movement in multiple different variables. So on the first x-axis, you've got MSTR price, and on the second x-axis, you've got the 10-year U.S. Treasury. So another thing I think is really fascinating here is as you as you or as the interest rates in the market fall, your cost of capital falls, and that should instantly move the price of strike higher because the yield, the relative yield that you're getting uh, on the stock is more attractive. So that's this second x-axis here over on the left-hand side. This is the 10-year US Treasury. So as interest rates fall, you estimate that the price of strike is going to go up. Now you've got multiple moving variables here, right? So you've got the cost of capital, and then you've got the underlying strategy price, MSTR common equity. So these two variables impact the price of strike. Now, one thing I think this model is a little rigid here, but um, as the price of strategy rises, and there should be some convexity, some curvature in this model, because as the price of strategy rises, the value of the call option becomes a larger proportion of the valuation of the strike instrument itself. So, right, like let's just say strategy goes up to $700, you're far closer to being in the money with that perpetual call option, right? It's a never ending call option, and you're far closer to being in the money. So the value of the option has a larger impact on the price of strike itself. And I think this model does a really good job of showing as the price of strike goes in the money above the conversion price, which is $1,000, it basically starts to trade as equity because it's closer to conversion. The yield has fallen drastically, and the incentive to convert into common equity, makes more sense. So, I recently came out with this visualization for the convertible bond after my conversation with Richard. I think this is a really interesting way to view these bonds in graphical format, and it's a pretty similar situation here with the preferred stock in that there's some convexity because this is a hybrid product and it's got multiple components that people can value. And as the price of MSTR rises, the preferred stock itself will start trading closer to the potential equity value. Here's a more realistic way to probably view the convertible or the perpetual preferred stock is the value of the preferred stock. Let's just follow the black line, right? So the value of the preferred stock is trading primarily a function of the underlying interest rate. And then there's an inflection point where the price of the underlying stock is going up so high that it starts to be more valuable. It starts to be more valuable, or the call option component starts to be more valuable. So there's a technical like pricing curve that's a function of all of these curves combined. I'll try to wrap my head around it and draw it out because it's a little bit different than this, but the price of the underlying preferred stock is a function of those multiple moving components. So why is this important? Let's go over to my Excel. So why is this important? And right, so Strategy just came out and said they're going to offer a $21 billion the preferred stock uh, ATM. That's huge, right? $21 billion preferred stock ATM, and a lot of people are scarred from the ATM because Saylor just hammered the ATM on the common stock during November and December and raised $20 billion of capital in 40 days and just bought Bitcoin with it. Now this is different, right? A $21 billion ATM on strike is different because this has got a call option component and the conversion premium significantly out of the money. It's right. It's 10 shares of strike represents 1 share of common stock. And you've got these multiple moving components going into time. So what I tried to demonstrate on the screen here, maybe I'll make it a little bit bigger. I'll walk through it. So what I tried to demonstrate here is, okay, you're going to issue $21 billion of strike. How do you do it? And there's been a lot of concern in the community about how are they going to pay the dividend if they issue $21 billion of preferred stock. That's going to be $1.9 billion of dividend that they need to pay out over time. So we're going to address that. We're going to walk through this and address it, right? So I assumed they made let's just say they make 1, 2, 3, 4 issuances of ATM, or 4 different tranches of ATM. Let's just say the first tranche is $2.5 billion. Maybe a couple months later it's $5 billion. A couple months later it's $7.5 billion. A couple months later it's $6 billion. So I try to estimate, okay, if the price of MSTR is rising, so that's column G here. If the price of MSTR is rising, so 265, 400, 550, 750, the current Fed funds rate is 4.33%. The dividend per share is $8. And I try to estimate what would the strike price be, because the price of strike, the preferred equity, as the price of strike rises, you're actually accreting more Bitcoin per share because it's less dilutive on the common stock equity. So, and you have less dividend required to pay as the price of strike is rising and you're issuing ATM into the price of strike. So, right. At these different strike prices, I've also backed into like, what is the proxy interest rate at these different strike prices? So this is a function of taking this $8 dividend per share, $8 dividend per share divided by the strike price. So that gets you an interest rate of 9 at $88, an interest rate of 8 at 100, 6 at 125, 5 at 150. And this next column over is to show, okay, this is just conceptually, this is a Fed funds rate plus 4.8%, Fed funds plus 3.7, Fed funds plus 2.1, Fed funds plus 1. And you start to ask the question, like, why would I take on this risk of getting a 5% interest rate, which is just 1% more than the Fed funds rate? That seems, strategy seems like it's much more risky than 1 point more than the Fed funds rate. And you would say yes. However, if the price of strategy is at $750 and it's really close to the conversion, then there's actually more value in the conversion component, right? So, I mean, I'm putting all of this together at the same time, and I know Ben figured this out 3 weeks ago when they announced this, so I feel like I'm behind here. But so in these instances of 4 different tranches of strike ATM, you would have different nominal number of strike shares that are issued, right? So 28 million, 50 million, 60 million, 40 million. And the dividend associated with it, right? Because the dividend is a function of how many shares are issued. So, if the price of strike is trading up at $150, if you want to raise $6 billion on that strike price, that would require 40 million shares, which would be $320 million of a dividend. So, a lot of people have asked this question: if there's a $21 billion ATM, how are they going to pay the $1.9 billion of dividend? Well, it's not. It's likely not going to be $1.9 billion of dividend, because as they start issuing this stuff, right? As they start issuing strike, there are no new shares that are hitting strategy, right? And as they start issuing strike, they're going to be slamming Bitcoin onto the balance sheet, and it's going to be wildly accretive. And there's going to be no people aren't going to be shorting MSTR as a function of their underlying holdings on strike. So you don't have this, crazy arb trade that's happened. Maybe there isn't. There likely is an arb trade happening behind the scenes somewhere, but I don't think it's as extreme as the convertible bond arbitrageurs. So basically, you have this future dilution that may happen at a future point in time, but only if the price of the stock goes above $1,000 per share, and likely well above $1,000 a share, which is a hint on where we're going here next. So in this circumstance of raising $21 billion on strike, if the average Bitcoin price is 100,000 on purchasing this $21 billion, MSTR would purchase 210,000 Bitcoin. As of today, they hold 499,000. So the Bitcoin held at the end would be 709,000. So I calculated a Bitcoin per share in, before held today, and then how much is held at the end, recognizing that there would be 17.8 million shares of MSTR common stock as a function of the strike issuance. So you've got fully diluted shares as of 3/13, estimated diluted shares afterwards. That would be 311. It goes from 294 million to 311 million. So this would represent a Bitcoin yield of 34%. So again, wildly accretive. Now, the next part I wanted to take into consideration, okay, what if interest rates drop 183 basis points down to 2.5%? So the Fed funds rate drops to 2.5%. Everything else here stays the same. However, the price of strike rises proportionately, right? So what I've done here in this example, the second example, I've held this Fed funds rate plus constant, representing the risk. I've held MSTR price constant and the Fed funds plus rate constant. And then you can back into what the strike price would be. So, $110,000 or $110, 130, 175, 230. So in this instance, I'll just direct your attention right to the bottom. The Bitcoin yield, right? If interest rates drop 183 basis points down to 2.5%, the Bitcoin yield gets better. It's even more accretive because you have to issue less shares, less dilutive, yada yada, et cetera, et cetera. Okay, so where are we going here? Why is this important? Okay, I think this is incredibly important here because and then in this circumstance, if interest rates drop to 2.5%, the amount of dividend that they may have to potentially pay drops as well. So you go from $1.4 billion dividend down to a $1 billion dividend. So you're like, yes, fingers crossed, interest rates come down, price of strike goes up, like massively more accretive for strategy, common stock shareholders. Like, hell yeah, let's do it. And based on the macro environment, I think that's kind of where we're going. So again, why is this important? What's going on? Let's try to put it all together, right? So what's the big story? You guys know I like to talk about the architecture of the market. Right. MSTR was included in QQQ in November of 2024. I have been in this trade for a very long time, recognizing that is a wildly bullish catalyst, but there's also another catalyst of the S&P 500, which can be incredibly accretive because there's significantly more buying and demand pressure on the underlying common stock equity that would come into play. As I've talked about and discussed in the past, the S&P 500, MSTR currently doesn't qualify. I think there's a high likelihood that they qualify if the price of Bitcoin continues to rise and either closes Q1 above 96,500 or closes Q2 above, 97 plus. I think there's that would erase the negative earnings over the last 3 quarters and would then instantly qualify them for the S&P 500. Why is this important? This is important because generally when companies are added to the S&P 500, they are added like near the market cap threshold that it requires to get in the S&P 500. The market cap threshold is around $15 billion. So most companies, when they get included, they start small and they get included around $15 billion or $20 billion if they've got positive earnings. Now, there are some instances where companies don't have positive earnings and there's this delay before they get added to the S&P 500. And that's what's happened with strategy. It's what also happened with Tesla back in 2021 or 2021. I mix it up. I think it's 2020. Where strategy's got almost a $70 billion market cap right now. So they're not included in the index already. They've already got a $70 billion market cap. That means when they get added to the S&P 500 index, they're getting added at around, 150th ranked company in the S&P 500 index, which results in a significant, massive amount of capital that's got to come in the door and buy strategy stock at any price, right? These are passive buyers. As we saw with QQQ, I think that was front run pretty significantly in November before the final announcement was made in December. And I think we could see a similar situation with potential S&P 500 front running here in the future. I don't think S&P 500 is priced in. The historical earnings have been negative for so long. I think the market is generally largely asleep to this. You can't price it in because there's this committee component, right? The S&P 500 committee has to approve of MSTR getting in. For some historical context, the S&P 500 committee didn't let Tesla in the very first quarter that they qualified. And because they delayed 1 quarter to add Tesla, and then everybody started front running it, right? The market cap of the company went from 300 billion to 700 billion in like 2 or 3 months. And it was just a massive increase in market cap. And then from there, when they got added, I think it went up to 1.2 billion, something like that, or 1.2 trillion. Sorry, it was a meteoric rise. It was absolutely front run. Everybody was watching where their earnings went from negative to positive, and that's when the market started front running Tesla getting included in the S&P 500. Okay, so why is it important? What am I showing on my screen? So how much capital follows and tracks the S&P 500, including all mutual funds? I leveraged Grok's deep search function, and I wanted it to scour the internet. And how does this compare to the NASDAQ 100? So I wanted to give a sense of scale, right? Like what's the scale difference between NASDAQ 100 and S&P 500? So research suggests total capital tracking the S&P 500, including all mutual funds, is approximately 4 to 5 trillion based on major fund assets. It seems likely that the NASDAQ 100 has around 364 billion in tracking capital, primarily through key ETFs like QQQ and QQQM. I think this is likely understated because there are pension funds and offices and other corporations around the world that pretty much just track the S&P 500 themselves, and they just don't buy an ETF. They just buy all the funds in the same weighting as the S&P 500. So the point of showing this here is the S&P 500 is more than 10 times the size of the NASDAQ 100. Granted, there's 500 companies in the S&P 500 and 100 in the NASDAQ 100. But still, when you're thinking about potential capital flows coming into MSTR as a function of getting included in this index, it might be 4 or 5 times the scale of the NASDAQ 100 inclusion. So it's a really big deal. Now, why is this important? I'm trying to piece this whole thing together here, which is I'm trying to get into the mind of Saylor. Like, what are they thinking about? And they mentioned they don't care about these index inclusion. That it's not a primary goal. Index inclusion isn't a primary goal. I think that's true, but it's hard to ignore, right? Because these are if you're talking about tapping capital pools, the S&P 500 is one of the biggest capital pools in the market. So why is this important? With the current $42 billion capital plan, there's $4 billion of ATM left, and there's like $18 billion of convertible debt left. And now they just announced this $21 billion strike ATM offering. So if Saylor came out and issued $21 billion of the strike offering, they would have this dividend that they would have to pay out over time and into the future. Now, however, they would be smash buying a ton of Bitcoin on the back end. They'd be buying, a couple 100,000 Bitcoin potentially with that $21 billion that are coming in the door. And that's going to push the price of Bitcoin up, right? That's going to push the price of Bitcoin up. And if that pushes the price of Bitcoin up, then that changes the impact of them potentially getting included in the S&P 500 in Q2 or Q3, right? If the price of Bitcoin is above 96,500 at the end of Q1, maybe a little bit higher, that would erase the negative earnings for their historical, the last 3 quarters. Now, people have said, oh, Saylor's just going to tap the ATM and just, if we get included in the S&P 500, he's just going to tap the ATM just like he did at QQQ. And I'm saying, hold on, wait a minute here, right? If you've got a $1.4 billion dividend burden that you have to pay, only if the price of the stock is under $1,000, right? Only if the preferred shares haven't converted. You have every incentive to let the price run, right? You have every incentive to let the price run, because if the price runs, you don't have to pay the dividend anymore. If the preferred stocks convert into equity, that dividend burden's gone, disappeared. You don't have a $1.4 billion dividend burden. And when you think about how aggressively Saylor tapped the ATM with QQQ, he raised $17 billion in 4 weeks. $17 billion in 4 weeks. Saylor only has $4.5 billion of the MSTR ATM left. So let's say the S&P 500 did happen. You could still raise $4 billion on using the MSTR ATM, but then also just totally tap out your common stock ATM and then just let the price run. Because if your preferred stock converts, then you don't have a dividend burden. And all of a sudden, the value of the MSTR common equity gets even more valuable, because you don't have that liability sitting on your balance sheet anymore, which should shove more volatility into the general stock, which would allow them to raise more convertible debt, because there would be more volatility going into the stock. So I think we're going higher. I think we're going higher. This strike offering, the $21 billion strike plan, is just it's a huge deal. And I think they could be really strategic here, recognizing where the market's going and how capital may flow into the stock. So I needed to get that thought out. This is the best way to get these types of thoughts out. So I appreciate it. If anybody's got any feedback on that thought, like I could be crazy here, but I think all the pieces moving together, that's probably how I would play this. I think there's incentive to let the stock run, because you want to free up that dividend. Well, actually, there's multiple reasons. One, you want to free up the dividend. You want to free up the dividend payment on the preferred stock. You want all of the convertible bonds to convert, to clear those off your balance sheet. Boom, your leverage ratio drops instantly. However, the vol should be high, so you'd be able to just issue a ton of convertible debt right on the top of it too, because the market would just be starving for more, as I discussed with Richard, right? Like with the convertible debt, here's the bond floor. This green line here is the convertible bond price. And as the price of MSTR rises, which is this dotted blue line here, the convertible bond price starts to track the underlying equity very closely. And so this highlighted green area is the amount of volatility arb that you have in the transaction, like when there's when the convertible bond price goes up and the equity goes up. And as you can see, there's very little green here, right? But when the price of MSTR goes down, there's a lot more volatility arb difference between potential difference between the price of the convertible bond and MSTR, the underlying common equity. So if we get a situation where the price runs, there's no more juice left to trade. So all the arb traders are going to be starving for more volatility. They're going to want to convert and sign up for the next one. So, all right, I think that's it. I'm going to go grab a beer with the Bitcoin people at this meetup. And yeah, none of this is financial advice. I probably should have said that at the beginning. Thank you, everybody, for watching. There's 5,200 people here on a Thursday night. That's crazy. Okay, take it easy, everybody. Have a good one.